Your funded account just hit a 3% drawdown. Nothing dramatic, just normal trading variance. Yet you find yourself checking your phone every 5 minutes, scrolling through trading forums looking for validation, and questioning whether your strategy still works. Meanwhile, another trader with the exact same drawdown is calmly reviewing his trade journal and planning tomorrow's setups. The difference between you isn't skill, experience, or market knowledge. It's how your respective minds have learned to process uncertainty and temporary setbacks. One brain treats drawdowns as existential threats requiring immediate solutions, while the other treats them as predictable business expenses requiring no emotional response whatsoever. This cognitive difference determines everything about your long-term trading success. What I'm about to reveal are 3 fundamental shifts in thinking that separate traders who compound wealth from traders who cycle through the same psychological patterns forever. Reference point theory. Your brain doesn't evaluate trading results in absolute terms, but always relative to arbitrary reference points that determine whether you feel successful or unsuccessful. Most traders unconsciously set reference points that guarantee psychological suffering regardless of their actual performance. They measure today's results against yesterday's best day, this month against their best month ever, or their account balance against their highest peak rather than against reasonable benchmarks. The psychological mechanism works through what behavioral economists call loss aversion relative to reference points. When your reference point is your account's all-time high, any balance below that level feels like a loss, even if you're still profitable overall. This creates chronic dissatisfaction that impairs decision-making because your brain is constantly trying to get back to arbitrary psychological benchmarks rather than focusing on systematic execution. Professional traders deliberately set reference points that support psychological stability rather than create emotional volatility. They might measure their performance against risk-free returns, against their average monthly results, or against specific process metrics that they can control directly. Their reference points are designed to generate psychological satisfaction from reasonable performance rather than frustration from falling short of unsustainable peaks. The cognitive reframe involves understanding that all feelings of success or failure in trading are artifacts of your chosen reference points, not objective measures of your performance quality. A 5% monthly return might feel terrible if you're comparing it to your best month ever, or feel amazing if you're comparing it to savings account returns. The market performance is identical, but your psychological experience depends entirely on your reference point selection. Advanced practitioners consciously choose different comparison standards depending on what serves their long-term development. During challenging periods, they might compare their performance to break even or to their worst historical periods. During strong periods, they might compare against more ambitious benchmarks to maintain motivation without becoming complacent. Probabilistic identity formation. Most traders build their identity around being right about market direction, creating psychological attachment to predictions that transforms neutral probability management into emotional validation seeking. Professional traders construct their identity around being effective probability managers who profit from uncertainty rather than eliminate it. This identity shift changes everything about how you experience wins, losses, and the trading process itself. The identity mechanism works through self-concept maintenance. Your brain will unconsciously adjust your behavior to remain consistent with how you define yourself. If you see yourself as someone who predicts markets accurately, losing trades threaten your identity and trigger psychological defenses that impair future decision-making. If you see yourself as someone who manages risk systematically, losing trades confirm your identity and reinforce positive trading behaviors. Probabilistic identity development requires consciously redefining what makes you successful as a trader. Instead of measuring success by prediction accuracy, you measure success by adherence to systematic processes that generate positive expectancy over time. Your identity becomes tied to consistency, discipline, and mathematical thinking, rather than to being right about individual market movements. The cognitive transformation involves shifting from deterministic thinking to probabilistic thinking about your own capabilities. Amateur traders think, I should be able to predict this move, or I should have seen that reversal coming. Professional traders think, my system should generate positive returns over sufficient sample sizes, or My process should keep losses small and let winners compound. Professional implementation creates process-oriented confidence, where your self-belief comes from trusting your systematic approach rather than from believing in your predictive abilities. This psychological foundation remains stable during losing streaks because it's not dependent on short-term outcomes, and it prevents overconfidence during winning streaks because it's not inflated by temporary success. Advanced identity formation involves understanding that your trading identity determines what information you notice, how you interpret results, and what actions feel natural versus forced. Traders with prediction-based identities naturally focus on being right and avoiding being wrong. Traders with probability-based identities naturally focus on following processes and managing uncertainty. The identity shift changes your entire relationship with markets from adversarial to collaborative. Perspective flexibility. Your brain's time horizon determines what feels significant versus insignificant in your trading results, yet most traders remain trapped in short-term perspective that transforms normal variance into emotional drama. Professional traders have developed the ability to consciously adjust their temporal perspective based on what serves their decision-making, rather than what feels natural in the moment. The psychological mechanism involves what cognitive scientists call temporal construal theory. Your brain processes the same events differently depending on whether you view them from short-term or long-term perspectives. A losing week feels devastating from a daily time frame, but might be completely insignificant from a yearly time frame. Your emotional response isn't determined by the events themselves, but by the temporal lens through which you view them. Temporal flexibility training involves practicing mentally zooming in and out of different time perspectives until you can consciously choose the time frame that supports optimal decision-making. When you're feeling frustrated about recent results, you zoom out to longer time frames where short-term noise becomes invisible. When you're becoming complacent about your success, you might zoom in to shorter time frames where recent improvements become more apparent. The cognitive application creates temporal perspective-taking, where you can mentally project yourself to different points in the future and evaluate current situations from those vantage points. How will this losing trade matter 6 months from now? How will this winning streak look from the perspective of next year's results? This mental time travel provides emotional regulation by contextualizing current experiences within larger patterns. Professional development involves understanding that your natural temporal perspective is usually misaligned with profitable trading psychology. Your brain evolved to focus on immediate threats and rewards, but trading profits compound over extended time periods that exceed your natural attention span. Training your mind to naturally think in longer time horizons creates emotional stability that supports systematic execution. Advanced temporal perspective work includes developing intertemporal choice optimization, where you make current decisions based on their impact on long-term outcomes rather than short-term feelings. This might involve taking losses today that hurt emotionally, but preserve capital for future opportunities, or avoiding profits today that feel good, but compromise long-term systematic development. The ultimate realization involves understanding that all trading psychology problems stem from temporal perspective misalignment. You're experiencing long-term probability games through short-term emotional filters. Adjust your temporal perspective to match your actual trading time horizon, and most psychological problems resolve automatically.